In today's video, we're going to take a look at 5 individual stocks. 5 stocks I've been getting asked about a lot lately. A couple of them are growth stocks, and a few of them are dividend-paying stocks. I'm going to go through and rank whether I believe they are a buy or a pass right now based on my opinion alone. And as you're going through the video, if you appreciate and like these videos and want more of them, then show me by hitting that like button down below, as I truly appreciate it and it really helps the growth of the channel. With that being said, let's jump into it. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive 10 of their best stocks to buy right now. All right, let's get back into the video, taking a look at 5 individual stocks, where we're going to rank them either a buy or a pass. And to give you a hint, 3 of them are buys and 2 of them are passes. Beginning with stock number 1, which is PayPal Holdings, stock ticker PYPL. PayPal is a fintech company that was a darling during the pandemic, as the stock rose to an all-time closing price of $308.53. Trading at a price of $62 today, this means the stock has fallen an incredible 80% from those closing all-time highs just a few years back. The company currently has a market cap of $67 billion, and over the past 12 months, the stock was down 10%. But in the past month alone, the stock has seen some momentum and has risen more than 10%. For those of you unfamiliar with PayPal, they actually originated as a part of eBay. But about a decade ago, the company spun off into its own publicly traded company, and now they are one of the most trusted online payment platforms on the market today. In addition, the company owns the likes of the popular application known as Venmo, where it's easy to exchange money from peer to peer. The intrigue when it comes to PayPal has been their rising revenues and earnings, even in the face of stiff competition from the likes of even Apple with Apple Pay and Google or Alphabet with Google Pay. Looking at this chart here, you can see that even in the face of this increased competition, revenues have been increasing year in and year out, and analysts expect that trend to continue moving forward. Earnings are expected to follow a similar trend, with analysts expecting EPS growth of 11% next year and 13% the following year. Expected 2024 EPS of $5.53 per share gives shares of PayPal an earnings multiple of just 11.2 times, which equates to a PEG ratio of 1.0. These both suggest the stock is undervalued, which is the reason I rate shares of PayPal as a buy. And it's not just me. Analysts are also bullish on the stock, rating the stock a buy with a 12-month price target of $74, implying roughly 20% upside from current levels. If you're an investor that's looking to take the next step in your investing and managing your portfolio, not only staying up with the market, but also getting that edge, definitely check out my newsletter, The Investor's Edge, where if you sign up for a premium membership, not only do you get to see my regular portfolio where I do monthly portfolio updates, we also do a stock deep dive on an individual stock every single week. We also give earnings recap reports and much more. Definitely check out the link to The Investor's Edge down in the description below, as we're running a 20% holiday special until the end of the year. Stock number 2 is Alphabet Incorporated, stock ticker GOOGL. And this company doesn't really need much of an introduction at all, as they are part of the Magnificent Seven, one of the largest mega cap technology stocks on the market today. I get questions about Google, or Alphabet I should say, all the time, and rightfully so. They are a fantastic company. And although they are part of the Magnificent Seven, and although they have a market cap of more than $1.7 trillion, and although the stock is up 55% over the past 12 months alone, the stock still looks like a great valuation moving forward. They have a lot of things going for them. The great thing and the intrigue when it comes to Alphabet is they're not overly reliant on one area of the business. Obviously, search is a big part of their business, as they have 2 of the largest search engines in the world today, with both Google as well as YouTube. They also have a dominant position, not the largest position, but a dominant, strong position in the cloud area. And how could I not forget? Artificial intelligence. The company has that double positive right now, where they continue to increase their top line revenues while also increasing their operating margins. The company's most recent quarter showed top line revenue growth of roughly 11%, to go along with operating margins of 28%. This was a 300 basis point increase from just a year ago. Moving forward, revenues are not expected to slow, as analysts see double-digit revenue growth each of the next 3 years. In terms of earnings per share, analysts are looking for 16% EPS growth each of the next 2 years alone. There are estimates that go further out, but as you know, anything can happen, so I don't really like to rely too far out in terms of estimates. But using the 2024 EPS estimate of $6.69 per share, shares of Google trade at a forward price-to-earnings ratio of 20.9 times, which is well below the company's 10-year historical average of 25 times. When it comes to rating shares of Alphabet, I rate them a buy, as it's one of my largest positions in my portfolio and a position that I am continuing to buy moving forward. Analysts also see some upside with the stock, as they have a 12-month price target of $154 per share, implying 10% upside from current levels. Stock number 3 on our list is NextEra Energy, stock ticker NEEE. NextEra Energy is obviously a utility company, so we're going from a mega cap tech to a utility company, the best performing sector to the worst performing sector. And given that I'm a value investor, a long-term value investor, I'm always searching for great companies at great valuations. And that's what you're going to find when we look into NextEra Energy. The company operates within a regulated portion of the business, and it also has its resources segment of the business. The regulated utility piece is reported as America's largest utility company. So in terms of size, this is a large company. NextEra is a way to play that growth in renewable resources moving forward. The company has a market cap of $122 billion, and over the past 12 months, remember I said utilities was the worst performing sector, the stock is down nearly 30%. This shouldn't really come as much of a surprise, as I already told you utilities was the worst performing sector, and one of the primary reasons was due to higher interest rates. A lot of folks invest in utility companies for the income, but right now in this high rate environment, there's a lot of income options that are out there with much less risk. Speaking of that income, NextEra is a dividend stock with a yield of 3.13%. They have a 5-year dividend growth rate of 11%, so we're getting some healthy dividend hikes, and the company has been increasing their dividend for 28 consecutive years and counting. In addition to that dividend growth, the stock also offers some growth potential. The stock is trading at a great valuation, as I mentioned a second ago, making the risk-reward opportunity look quite intriguing. Analysts are looking for NEE to generate EPS of $3.40 per share next year, which equates to a multiple of 17.5 times, well below the company's 5-year historical average of 30 times. When it comes to rating shares of NEE, I rate them a buy, and it's a stock that I've been buying in recent weeks, both for the dividend income, the growing dividend income, as well as the great valuation. Analysts tend to agree, as they rate the stock a buy as well, with a 12-month price target of roughly $70, implying 17% upside from current levels. Stock number 4 we're going to look at today is General Mills, stock ticker GIS. This is the stock that I got asked about just a few days ago, but knowing that their earnings report were coming, I wanted to wait to take a look at those before I answered and gave my personal opinion on the company. For those of you that are unaware, General Mills operates as a packaged foods company within the consumer staples segment. The company has been negatively impacted in 2023 with all of the attention that these magic weight loss pills have been getting, things like Ozempic. And I've talked about this a little bit when covering stocks like Coca-Cola as well as PepsiCo, but I believe those two are a little bit different than General Mills. Those companies have a much different product base when it comes to competing with these magic pills. But when it comes to General Mills, I'm a little bit more concerned just due to the fact of how much sugary products they have within their portfolio. Things like sugary cereals, things like sugary cookies, muffins, and the list goes on. This is an area that I believe will continue to struggle in the near term. And over the past 12 months, the stock is down 25%. And they operate with a market cap of $37 billion. Revenue estimates over the next 3 years are barely positive at all. Next year's revenues are relatively flat. With the following 2 years, analysts are expecting only 1 to 2% top-line revenue growth. This puts a lot of pressure on management to find areas to be more efficient in order to generate some EPS growth. And speaking of that, over the next 3 years, analysts are looking for EPS growth in the low to mid single digits. Using the 2024 EPS projections of $4.50 per share, shares of GIS trade at an earnings multiple of 14.2 times. Just comparing the company's price to earnings metric with their 5-year average, which is about 17 times, that there alone can't be the only thing you do. You need to bring everything together. Look at all the other metrics and the impact moving forward of what I believe the GL1 drugs will have on the company. It's obviously going to weigh on revenues. I believe it's going to weigh on free cash flow as well. So with that being said, General Mills, I rate as a pass right now because I think there's a lot of headwinds for the company moving forward and a lot of other great opportunities for me to put my money to work. Analysts tend to agree with me right now as they rate the stock a hold with a 12-month price target of just $68, implying only 6% upside from current levels. The fifth and final stock we're going to look at today is Brunswick Corporation. Now, this isn't a particular company that I've ever covered on this channel alone right now, so it was interesting to do some due diligence on as I was looking at it because I got some questions in the past. For those of you unfamiliar with Brunswick Corporation, they operate out of the consumer discretionary sector and really focused on leisure activities. Given that they are very cyclical, really depending on a strong economy for their business to do quite well. The company has a big presence in the boating industry, owning names like Sea Ray and Mercury Marine, which builds a lot of the engines that go in a variety of different boats. In addition, they have a Freedom Boat Club, as well as a presence within the bowling industry as well. So as you could see with that, they are really focused on that leisure customer. They are looking for the high dollar, high net worth. And when the economy is doing great, there's a lot of extra money. When wages are going up, there's extra money. When the economy is strong, they go out and buy boats. They buy boat club memberships. They go bowling on a regular basis. All of these things impact Brunswick. But if we fall into a recession like many are looking for in 2024, then we might see consumers and wages start to come down. We might see unemployment tick a little bit higher, and we might start seeing consumers' wallets tighten up a bit. All of this could weigh on a company like Brunswick, at least in the near term. Looking further out on the stock chart, you can see that the stock fell to below $20 during the pandemic, and even further out to around $1 per share during the depths of the great financial crisis. This obviously has nothing to do with the quality of the products Brunswick offers, but merely the fact that, in my opinion, I believe a better time to own them would be in the future at a lower price. Shares of Brunswick currently trade slightly below $100 per share with a market cap of $7 billion. Over the past 12 months, with the economy doing well and wages up and unemployment low, shares have climbed more than 30%, which completely makes sense. Analysts believe it will be a few years until revenue growth returns, though, with 2023 expected revenue declines of nearly 5%, followed by 2% revenue declines next year as well, before potentially recovering in 2025. EPS is even worse, with the expected decline of 10% this year, followed by a 3% decline in 2024, before eventually returning to EPS growth in 2025. So if we're looking at valuation using the 2024 expected EPS of $8.75, this has shares of Brunswick trading at a forward price to earnings multiple of 11.1 times, which is about in line with their 5-year historical average of 11.9 times. A slowing economy, the potential for increased unemployment, although offset by rate cuts to a degree, has me concerned about Brunswick, at least in the near term. I believe there's going to be a better opportunity, in my opinion, to look at shares of Brunswick in the future. That's why I rate them as a pass. Analysts appear to agree as they have a 12-month price target of $90 per share, which implies 7% downside from current levels, which again does not sound all that intriguing by any means. So with that being said, kind of a new video format. Let me know by hitting that like button and let me know down in the comments section whether you believe that these 5 stocks are either a buy or a pass right now. And if you want more videos like this in the future, definitely let me know down in the comment section as well. Thanks again for watching. And if you haven't done so yet, again, please smash that like button down below as I truly appreciate it. And we'll see you in the next one. Take care.